Did you know that choosing the best mutual fund investing strategy can boost your returns by over 10%? Imagine what that extra growth of 10 to 12% could mean for your financial future. Today, we'll explore how to choose the best mutual fund investing strategies for maximized returns for you as a common layman. Research shows that mutual funds have delivered over 12%, delivered up to 12% more returns annually than traditional savings methods in India. And with the right strategy, you can maximize your returns even more. And I have found that many investors, that's my research says, many investors miss out on significant gains because they don't know, they don't understand how to select the best mutual fund strategies that fit their financial goals and their risk tolerance. Hi, I'm Taresh Bhatia, a certified financial planner CFP and your go-to financial freedom specialist. I'm also the author of the Amazon bestseller book, The Richness Principles, where I share actionable steps for achieving financial success and independence. As a coach at the Richness Academy, I help working professionals, entrepreneurs, families, individuals build their wealth, reduce financial stress, and create a rich, fulfilling life forever. With over 38 years experience in financial planning, I've guided countless individuals and families through tax planning, wealth creation, and achieving financial freedom. Do make sure to subscribe to my YouTube channel, Taresh Bhatia, for more such insights on how you can build your financial freedom and master the best investment strategies. Don't forget to hit the notification bell so you never miss an update. Many investors struggle with how to choose the best mutual fund and don't know the best mutual fund investing strategies, and they often miss out on potential gains due to some common pitfalls. Whether it's confusion over the market trends or lack of clarity about personal goals, these obstacles can prevent you from reaching your financial potential. Welcome to today's video on how to choose the best mutual fund investment strategies for maximized returns. Whether you have or you are new to mutual funds or are a seasoned investor, this video will guide you through the strategies that can help you to make the informed best decisions and effective investment decisions. Stay till the end because I'm going to give you some free gifts. Watch till the end. Mutual funds offer a diversified and professionally managed way to invest, but with so many options available, how do you choose the right strategy? In this video, I'll take you through a step-by-step process through how you can select the best mutual fund strategies based on your age, risk profile, income, and financial goals to ensure you get the maximum returns. Let's start. The first is, how do I choose mutual funds? The first step in creating the best mutual fund investing strategy is understanding your personal circumstances. You should choose your funds based on several key factors, and I explain these one by one. But before I proceed, my disclaimer on this video and these recommendations. These are not any recommendations for any named mutual funds. It's only a suggestion. These are not tips. These are suggestions given to you to understand better for illustration purposes. And this video gives you an idea on how to proceed and how things happen at the back end when a mutual fund distributor or a financial planner advises you on the best mutual funds. So a good financial advisor will help you to shortlist the exact names. That's what I do for my clients. Now, this disclaimer, please keep in mind. My selection criteria is based on 4 points. I choose only close-ended because I believe when certain funds have performed well over a period of time and I can evaluate based on data available with me, which I'm not aggressive on new fund offers. Therefore, I can choose better and evaluate time to time what I've recommended to my clients, and they are measurable. So this is not based on returns, how returns would come in, or past returns. So they have no meaning for me or little meaning. But for certain people, past returns, take them. Continue year to year. Biggest mistake. I take ratios for study. How various ratios are performing for the funds which I'm trying to select. And I will explain how. And I'm looking at, for this illustration purpose, only the regular plan options in mutual funds in India. Having said that, I will go to next point and explain you how you can understand this much better. My clear strategy is that I am taking here for long-term investment strategies, not for any short-term. For short-term, I have a separate video. Go and watch on my YouTube channel, short-term strategies for investing for 1 to 3 years. So if you're investing over a very long time, this is for you. Continue understanding how I make the selection and what I'm going to make recommendations to you. So first selection is, after I've understood a client's profile, risk appetite, goals, time horizon, I would recommend small caps who have given an average CAGR of 18 to 20% plus. There are total 49 categories, 49 funds in this particular category when I do the analysis. And the highest average has been 20 to 25% in 3.5 years exact, which means they're doubling in 3.5. So you invest 10,000 rupees, doubled in 3.5 years if you're choosing small cap fund. So in my language, this is an alpha of 5%, which means over the risk-free return, there is an alpha of 5%. Now, if you invest 10,000 rupees per month for illustration purpose, let's understand how it will grow over a period of 10 years. Assumed rate of return, as I said, these have given already 25% return. So let's take assumed return of 22%. So your 10,000 per month can grow to 43 lakhs in a period of 10 years. If you step up every year, because I've explained in a separate video how you can step up because your income increases by 10% assumed every year. So if you start putting that extra 10%, which means 10,000 first year, second year 11,000, then on 11,000, 10% you go on adding. So this 43 lakhs becomes 57 lakhs, 86,000. So major jump if you start planning for your future goals. My second recommendation is at the moment, which is in September 24, total of 31 funds under multi-cap. So I'm recommending multi-cap strategies, multi-cap mutual funds. Average CAGR of 18 plus has been delivered. If I'm looking at CAGR, the average highest is 20%, alpha of about 3%. So evaluating these 31 funds is my task for my clients, and alpha of 3%. Let's look at another third category which I recommend to my clients, flexi cap. Highest average, which means 3.5 years, 18 to 22%, doubling in 3.5 years. Alpha of 4 to 6. So if you're investing in flexi cap 10,000 rupees per month over a 10-year period, your wealth grows to 33 lakhs 62,000 at an assumed rate of return of 18%. And you step up by 10%, this 33 lakhs becomes 46 lakhs in the same period of 10 years. So look at increasing every year. Fourth category of fund categories which I would recommend are large and mid cap categories. There are 36 funds in this category, and I do analysis of 36 funds to tell my clients which is that one fund or two fund most suitable for you. So out of 33, out of 36 have delivered 20%, average return of 20%, 25%. The worst has been 20%. Therefore, an alpha of 4%. And for an illustration purpose, if you are taking large and mid cap funds, your 10,000 rupees per month for a period of 10 year invested becomes 53 lakhs 28,000 at an assumed return of 25% CAGR year to year. And if you use step up method, the same 53 lakhs becomes 69 lakhs. So major difference if you go on stepping up. Fifth category are index funds. Now these are very favorite of certain fin influencers, certain coaches and mentors who say index funds are the best because of a lot of reasons. I don't agree. But here I'm putting it in the fifth category. There are 135 funds in this category. Out of the top 50 funds available, one out of these 135 have given 15% plus return year to year in my study, an average of 12%, and therefore can be considered at the fifth level. My sixth category is ELSS, also combining, because this helps you to save taxes under Section 80C of the Income Tax Act. So ELSS, Equity Linked Savings Schemes, becomes my sixth favorite. There are 33 out of 36 funds in this category which have delivered over 20% return. So if you invested 10,000 rupees per month over a period of 10 years, based on CAGR of the same 20% return which is possible, you can create a wealth of 38 lakhs 23,000 within a period of 10 years at this assumed rate of return with a lock-in of 3 years year to year. So if you invested in 24 till 27 gets locked, you can withdraw on 365 days into 3 exact number of day you can withdraw, and this 38 lakhs based on that calculation is an assumed rate of return. Comparison, do it with another parallel PPF, it would have given you just 18 lakhs 94,000 at an assumed rate of return of 8.5% per annum, which may be what has been the rate of return between 8 and 9. So I've assumed at 8.5 for calculation purposes. Isn't 18 giving double 38 lakhs in ELSS? Think. There are furthermore 60 funds in this category, average of 22%. The worst has delivered 13% and alpha of 5%. So this is a quick showdown of all the mutual funds. In this 6 selections I would give to my client, maybe just 1, 3 or 1 of the top 3 categories depending on my client's risk appetite, goal, time horizon, and he has understood to review every 3 months, every 6 months, every year. If a fund is not performing, it has to be stopped. A new SIP has to be started based on the fresh criteria, and those criteria I will explain. So this is a small study on how I explain to my clients how they are going to be understanding best mutual fund strategies. To explain this better, I've done a comparison between all the 6 categories I explained earlier in this video, and I've explained a summary, risk appetite, what duration you should be investing and therefore selecting this category of fund, and the expected kind of return of each category of funds. Now this return is just for a common layman to understand how these category of funds perform over a period of time. And for explanation, understanding and illustration purposes, I've shown this table. Now this table is a comparison, as you see, between the categories here, the small cap, large cap, multi cap, flexi cap, Nifty index and ELSS. I've given the summary of how you can understand that this is for what purpose. So small cap is for high growth, is for high risk appetite, duration of 7 to 10 years, being monitored by a financial planner like me, a year to year, see that that category in the mutual fund, small cap, is performing or not as per my parameters, and could be delivering 18 to 22% plus returns year to year. Now, slightly less risk, you can say, comes the large cap and the mid cap with high growth potential, and accordingly. Then large and mid cap, then multi cap, then flexi cap, then index 50 index, and last being ELSS. Now this is not in this order. I've just categorized them in this table for you to understand how this works out. If you like this, put in the comments below in the YouTube how you have liked it and whether you would like me to present such tables, research, and make it easy for you to understand Do press the bell icon so that you receive more of such videos and you get notified. Subscribe to my YouTube channel. Share with your friends that this kind of a categorization is awesome to understand various categories of mutual funds simply. Now I'll give you a simplified table to understand age-wise how you should choose and make a portfolio based on your age and your risk appetite and the amount which you are looking to invest. So your incomes, your amount to invest, segregated according to a portfolio age-wise. This is a table I will explain. So for example, you are in your 20s and you have an income of, and your category falls in 5 lakh rupees less, 5 to 10 lakh rupees or 10 lakhs and above. So if your age is this, then 75% in equity, 25% in debt. This goes on more, 80%, 80 to 20 if your income, if you're investing 10 lakhs and above. Now when you're investing in equity, 100% there, then I recommend small cap, as I explained, 30%, large cap 30%, multi cap 20%. You could look at 20% in Nifty 50 index, and if you're saving any ELSS, then that depends. So this makes up 100% here, and accordingly, if you're investing 10 lakh rupees per annum, then this ratio also increases. So accordingly, I'll give this in the download. You can download it from the link below. If you're in your 30s, let's understand simplified. If you're in your 30s, I would recommend 70%, 30% if you're investing below 5 lakhs. If you're above 10 lakhs per annum, like a 1 lakh rupees per month, then it could be 80 to 20 ratio in your 30s to 40s with goals, time frame, and your risk profile aligned together in a financial plan. If that plan indicates this is how you should be, so perhaps you can look at this, and this is how ideally your financial planner would recommend. This is for your understanding only. Now here I would again recommend 30% to be in small cap for this category of people, large cap 10%, multi cap 30%, flexi cap 10%, and 10% of you could include 20% of Nifty 50 index. Look at the chart at detail so that you understand how this can be made better. So this is just for the illustration purpose that I showed age wise, investment wise, how much you can break down when it comes to equity mutual funds, how this can be brought down. I'll give you some tips now on guiding principles for tax planning. 4 points here, 5 points. First is that you optimize your ELSS investments if you're looking at ATC, if that is what you're looking at to save taxes under section ATC deductions. And again, a lot of choices are there, but primarily tax efficiency under ELSS, and it makes ELSS as an attractive option for those seeking potential high returns, significant tax savings. Capital gains from ELSS, please note, is increased from 12.5% with effect from 23rd July 2024, and this is for a compulsory lock-in of 3 years. So that's ELSS point number 1. Capital gains, long-term capital gains for tax adjustments. Now the update requires you to investors to carefully plan their withdrawals with minimizing the tax impact. How do you do that? 2 points, my 2 inputs. Spread your redemptions over multiple financial years. That can help you to optimize tax efficiency, particularly by making the most of the tax rupees 1.25 lakhs exemption each financial year. This is effective from 23rd July 2024 as the budget was passed and the regulation implemented. My third input to you is to understanding the new capital gains tax, that the Union Budget 24-25 introduced higher tax rates for both short-term and long-term. When you're investing, so understand carefully STCG and LTCG. How do they impact you? Now STCG will impact you because the tax on gains from equity mutual funds held for less than 1 year has been increased from 15% to 20%. That's the STCG. So understand that carefully. The tax on long-term capital gains on equity mutual funds, which I'm explaining, held for more than 1 year, has been increased from 10 to 12.5, and the exemption limit has been increased also from rupees 1 lakh to 1.25. So this is to understand and keep in mind. So this lower STCG, this increase is something investors need to consider, particularly in equity heavy portfolios. So understand carefully in future what you're investing, their LTCG, their long-term capital gains, what impacts they will have before you make investments. So understanding the capital gains taxes is important. Understanding the LTCG adjustments you do. Understanding that if you've done an ELSS, what is the implication? The last is that the budget 23 eliminated the indexation benefit for debt mutual funds which have been purchased on or before 1st April 23. Now, what does this mean? Now, they will be now taxed for investors' tax slab, aligning with the fixed deposit taxation. Non-equity assets, therefore, which include debt mutual funds, real estate and gold, LTCG on these assets is taxed at 12.5 without indexation, which was previously used to increase and adjust the purchase price for inflation, therefore reducing the taxable gains. So this benefit is now gone. So these are the 5 points which I wanted to understand, guiding principles on tax planning. What else would you like to know? Put in the comments below. I have put in a separately 27 benefits of mutual funds to quickly take you through. In my opinion, better taxation, lower turnover ratio is there because you're not doing trading of specific stocks. There is good diversification. Minimum of 10 up to 50 and more funds are selected by the mutual fund, therefore offering you diversification and helping you to manage risk and the tax impact also. Accessibility, with just 500 rupees a month, you can start investing. Flexibility per month, frequency, adjusting your portfolio for changing the market conditions and the tax laws, and therefore you optimize everything for tax efficiency also. You can do strategic asset allocation, which offers you a wide array of asset classes. There's equity, debt, and mix of funds. It's hybrid. So tailored to your financial goals, risk appetite, and your tax considerations, you can choose accordingly. My opinion, number 7, they're professionally managed by experienced fund managers who are taking informed decisions to maximize returns while looking at lowest risk as such. So mutual funds offer high liquidity. Within couple of hours, you get redemption into your bank account, and there are no penalties as such for early redemption except lock-in and where the terms are there. All mutual funds offer absolute transparency, updated portfolio to you, holdings and the cost involved. So they are highly regulated. I haven't seen any scam here. And the economies of scale while you're investing in mutual funds helps you much better. SIP, I have a separate video on this which explains disciplined investing, how much you get, small amounts, easier to create wealth, and a very convenient method of entering into mutual funds. Low cost barrier, 500 rupees a month at very less cost to enter. Cost effective because the expense ratio while you invest is very low and is transparent. Regularly, these are monitored by regulatory authorities and highly regulated by SEBI, ensuring investor protection and adherence to strict standards. I would say always have it goal-based so that you understand when I need money, for what purpose, and therefore the investments has been done. No mutual funds have seen any scams the last 30, 35, 40 years. So making it less susceptible to scams and frauds compared to any other investment opportunities. There is no AMC closures. There may have been mergers, acquisitions, but they just can't wind up and go from India. So be very, very rest assured on this aspect. Strong and robust economy of India helping us at 7.6% GDP rate, solid foundation for mutual fund investing to thrive. My 19th input is that mutual fund industry AUM today is over 56 lakh crores as of today in July, in September. You can find out more details at this website. So if you see the last couple of years, from April 23 to March 24, this 1 year, just 10 lakh crore SIPs were added. From April 24 to July 24, 13 lakh crores SIP was added just in 4 months. And previously, the total mutual fund folios stood at 19.10 crores. That's 191 million folios as of June 24. So amazing stats to prove that Indian investor in mutual funds is in for a really great time ahead. So investing in a disciplined manner without worrying for volatility and without wondering how I can time the market, which is not necessary. Mutual fund Indias are required to be regulated by SEBI. So there are no hidden charges. They disclose all their fees and charges upfront, therefore ensuring transparency and protect your interest as such. You can also access international funds if you wish to. Ease of management of mutual funds is much simpler. Automatic rebalancing is possible. You can regularly review various income options if you're looking at income, especially for retirees. There is therefore no need for going into stock markets directly. And with adequate research and analysis like I do for my clients, it makes it absolutely great because the analysis which is conducted by the fund managers at one side may not be feasible for you as a common layman or an individual investor. There's something called as rupee cost averaging. So through SIPs, month to month, you buy high, you buy low. There is average advantage of rupee cost averaging. So this reduces the impact of market volatility by spreading your investments over a period of time. How do you like it? Amazing analysis I've done. Put in the comments below how you liked it and give me thoughts on what more would you. If you want to read more, go to my blog, blog.tareshbhatia.com, and this link which I've given below in the description, how to choose the mutual fund investing guide for maximum returns, and put in your comments below. So to wrap up, mutual fund investing in 2024-25 offers tremendous potential, but choosing the best mutual fund investing strategy is the key to maximizing your returns. Considering your age, risk appetite, income and goals when you build this portfolio. Remember, success doesn't come from chasing returns, but from making informed, strategic decisions. Thank you very much for watching this video. If you found this video helpful, please like, share, subscribe to my YouTube channel Taresh Bhatia for more such expert insights on how to choose the best mutual fund investment strategies for maximizing your returns. Visit my website tareshbhatia.com to explore more on personalized financial planning services and join my community where we deep dive even deeper into these strategies. Visit my website, The Richness Academy, so that you can understand how you can join my live webinar, Richness Masterclass. Thank you very much. I hope you liked the video and do comments how you liked it. Thank you very much.